All right, let's decode options. Diving deep into option volatility and pricing. You ready to master this? Repetition is key, so rewind is needed. We'll make options crystal clear.
Absolutely. Think of it like building a solid foundation, brick by brick.
Natenberg starts with a brilliant analogy. Options as insurance. Like buying an option is like paying an insurance premium.
Spot on. Protecting yourself, like car insurance, right? You pay to cover accidents. Options are financial protection. You pay up front, that's the premium. And if market goes against you, well, the option's your safety net.
So instead of fender benders, it's protecting my investments.
Precisely. Say you buy a call option. You have the right, not the obligation, to buy at a set price, the strike price, before a certain date.
Okay.
Now, if the price goes up, you exercise your option, buy low, lock in profit. But if the price tacks, you let it expire, your max loss. Just the premium.
So a safety net if things go bad. Starting to see this insurance link.
Just like insurance policies have terms, different options offer different protection, calls, puts, even combo strategies. But first, let's clear up some lingo, long and short.
Those always confuse me.
It's simple. Long means you bought it. Short means you sold it. Like owning a house versus renting. Long, you're buying, paying a premium. Short, you're selling, getting the premium.
So buying's going long, selling's going short, but why sell or go short? Seems riskier.
Great question. When you sell, you're betting the market won't move much. You collect that premium, hoping the option expires worthless. You win, you keep it all. But if the market goes against you, big losses. Riskier than buying, yeah.
So higher risk, but possibly higher reward.
You got it. That's why knowing long and short is so important. Lets you tailor your strategy to your outlook, your risk tolerance.
Right, now Natenberg compares options to futures contracts. What's the big difference?
Obligation. Options give you the right, but you don't have to buy or sell. Futures, you're locked in. Buy a futures contract, you must buy the asset at that price, on that date. Same with selling.
Options, I have a choice. Futures, I'm stuck.
You got it. Different obligations, different risks. With options, max loss is the premium. Futures, potentially unlimited loss. You're obligated even if the market crashes.
Obligation, clear as day now, thanks. Natenberg talks about margin requirements in futures. What are those?
Futures are riskier, right? Margin's a safety net for the exchange, like a security deposit. You deposit money, the margin with the broker, ensures you can cover losses.
So margin protects the exchange, not me. Make sure traders can pay up.
Exactly. Keeps the market safe, minimizes defaults.
Got it. Natenberg mentions two ways to exit a futures position before maturity. Offsetting and physical settlement.
Right. Offsetting's most common. Say you bought oil futures, want to get out. You sell an identical contract, cancel in the buy. That's how most traders handle it.
Reversing the trade.
Precisely. Then there's physical settlement. That happens on the maturity date. You hold till then, you have to take delivery. Barrels of oil. Most traders offset to avoid that.
Yeah, no oil tankers at my house, so offsetting's like hitting new dough.
It is. Gives futures traders flexibility.
This is making more sense. Okay, time for fair forward pricing, another Natenberg concept.
It's all about figuring out future worth, considering all the factors, like what's a house worth in a year? You'd think about the market, interest rates, renovations.
Estimating future price based on current info and future costs, benefits?
Right. Say you want land with oil, buy now, or a forward contract to buy later. To get a fair forward price, you look at the land price, the potential oil money, interest on that, and oil storage costs.
Balancing present value with future gains and costs, a complex equation.
Exactly. Make sure buyer and seller get a fair deal, the time value of money, future uncertainties.
Starting to grasp fair forward pricing. Now, two terms that always trip me up. Contango and backwardation.
These are all about commodity futures market structure. Normal market, it's contango. Later futures cost more than near-term ones, like storing something longer costs more, so you pay extra for later delivery.
Contango, further out, higher price. What about backwardation?
Backwardation's the opposite. Futures prices are lower than the current price. Happens when there's huge immediate demand. Shortages, disruptions, buyers want it now, pay a premium for immediate delivery.
Backwardation, like a need-it-now market, so spot price higher than future prices?
You got it. Backwardation means unusual market stuff, a signal traders watch closely.
Like a secret market language. Now, Natenberg throws in the carry trade. Sounds risky, but intriguing.
The carry trade is exploiting interest rate differences between currencies. Borrow where rates are low, invest where they're high. Pocket the difference.
Borrow low, invest high. Clever. But there's got to be a catch.
Of course. Exchange rates. If the currency you invested in drops against the one you borrowed in, your profits disappear. Could even lose.
Balancing act. Profit versus currency risk. Betting the interest rate difference beats currency moves.
Exactly. Needs careful thought. Understand interest rates and currency markets. But before we get too deep into that, let's recap. Important to have a solid base.
Good idea. A recap would be great.
We started with options as insurance, then long and short positions like owning versus renting. Futures contracts, obligation, margin requirements, Fair forward pricing, thinking about storage and future benefits, contango and backwardation. Finally, the carry trade, its rewards and risks.
Great summary. Feeling more confident with these basics of options and futures. What's next in Natenberg's world?
Now we've laid the groundwork, let's see how options actually work. Option expiration, settlement, and the biggies. Intrinsic and time value. Ready for the next step?
Absolutely. Let's unpack those option mechanics.
All right, option expiration and settlement. Imagine a call option. Gives you the right to buy a stock at a price, the strike price, before a date. The expiration date, like a deadline.
Use it or lose it.
You got it. Before expiration, decide. Exercise your right to buy or let the option expire, worthless.
Expiration date, the last chance. What about actually exercising or letting it expire?
Last trading day is usually the business day before expiration. To exercise, tell your broker before market close.
TikTok, what if I don't exercise?
It expires. You lose the premium, like letting a coupon expire.
Got it. Got to act before it's too late. Natenberg mentions assignment. What's that about?
Assignments when you're the seller. And the buyer exercises, you sold a put option, right? Gave someone the right to sell you stock at a price. If the stock drops below that price, they might exercise. Sell you those shares. That's assignment.
I'm forced to buy, even if I don't want to.
You got it. But remember, you got that premium when you sold? That's your compensation for the obligation.
So assignment's the flip side of exercising. I exercise, someone gets assigned.
Right. Two-side. One trader's exercise is another's assignment. Key part of how the options market works.
Pieces fitting together. Natenberg then talks about intrinsic value and time value. A bit abstract. Help us break it down.
Think of an add-on like a cake. 2-layer. The bottom layer, that's intrinsic value. The actual edible part. The profit if you exercised right now.
The value right now, assuming I used it.
Right. Call option, intrinsic value is the difference between stock price and strike price. If the stock's higher, stock low. Zero intrinsic value.
So stock's at $50. I have a call, strikes $45. Intrinsic value is $5.
Exactly. Now the top layer, that's time value, the icing. Potential sweetness, how much more profitable the option could get.
Future gains.
Yeah. It's what you pay for the chance the price moves the right way before expiration.
More time till expiration, more chance for big moves, higher time value.
You got it. As we get closer to expiration, time value disappears, like ice cream melting. Time decay, super important concept for options traders.
Okay, time decay makes sense now. Then Natenberg gets into P&L graphs. Those sound a bit intimidating.
No worries, they're just pictures. Show how an option's profit or loss changes at expiration. Different price scenarios, like roadmaps, show potential outcomes.
So a graph shows me how much I make or lose based on where the price ends up.
Exactly. Buy a call option, the graph shows if the price is below the strike at expiration, you lose the premium. Price above the strike. Profit grows as the price rises.
Visually see my profit or loss at different prices. What about complex strategies? Multiple options. Do they have those graphs too?
Absolutely. Actually, even more useful for those. See, the combined effects of all the options can get more complex with peaks and valleys, different profit and loss zones.
So P&L graphs are like X-ray vision for options, seeing how the strategies could play out.
Exactly. See the risks and rewards of different positions, different strategies.
Incredibly helpful. Now, the elephant in the room, volatility. Natenberg stresses how important it is, but it's still kind of fuzzy for me.
Volatility, that's the heart of options, how much the price is expected to swing around over a period of time. Think of it like the market's mood swings, calm or wild.
So high volatility, big swings, low, smaller, predictable.
Exactly. And since option value comes from those swings, volatility is the key to pricing options.
Wilder the market, more valuable the options.
You got it. To really get volatility in pricing, Natenberg brings up casinos.
Casinos. Interesting.
Think of roulette. Betting on red, the odds are slightly against you. Because of that green zero, many spins, casino wins, right?
The house always wins, but how's that like options?
Selling overpriced options, that's like being the casino. You bet the asset won't move enough for the buyer to profit. You're right, you keep the premium.
So understanding volatility is like knowing the odds. Better I know, better my chances.
Exactly. And to get deeper into volatility, we go back to stats class. Normal distribution, bell curves.
Right, vaguely. Something about standard deviations?
On the right track. Flip a coin 10 times. Most likely outcome. Close to 5 heads. Further from that, less likely. That's normal distribution. Probabilities clustered around the average.
So peak of the curve is most likely. The tails are the extremes.
Exactly. How it connects to volatility. Volatility is the standard deviation. Fancy way of saying how spread out those probabilities are around the average price.
Wider curve, higher volatility. Narrow curves, lower.
You got it. Natenberg has this rule of thumb. Over a year, 68% chance the price stays within one standard deviation of the average.
Helpful. So stock, average $100, volatility 20%. 68% chance it trades between $80 and $120 over the year.
Right. Want a wider range? 2 or 3 standard deviations? 95% chance the price stays within 2. 99.7% chance it stays within 3.
Those standard deviations give a likely price range based on volatility. But Natenberg talks about implied volatility. Sounds mysterious.
Implied volatility, that's the market's crystal ball, the volatility already baked into the option prices.
What the market believes, even if it's different from past volatility.
Right, like the market's best guess about how volatile it'll get.
How do we figure out implied volatility? Sounds complicated.
There are fancy models, but here's a simpler way. Say an option's trading higher than a pricing model suggests. Based on historical volatility, that difference means the market expects higher volatility in the future. Higher implied volatility.
So option trading at a premium, maybe the market expects things to go wild.
Exactly. Implied volatility gives clues. Compare expected future volatility with implied. Find good trades. Think markets underestimating volatility. Buy options. Overestimating. Sell.
So implied volatility is a secret weapon for options traders. Understanding what the market thinks, trying to outsmart it.
You're getting it. Powerful tool. But just one piece. Successful trading takes understanding everything we've talked about, managing risk, analysis.
This is all coming together. Volatility is the pulse. But there's so much more. What else does Natenberg say about it?
He looks at how it acts in real markets. Implied volatility often forms patterns across different strike prices. Traders call it volatility skew or a smile.
So different implied volatility for different strike prices, even with the same expiration. Why?
Market psychology, historical patterns, stocks, options with lower strikes further out of the money have higher implied volatility. Traders pay a premium for the protection of puts, especially when the market's uncertain.
Fear in the air, implied volatility for those puts spikes.
Right. Insurance premium goes up when risk seems higher. That pattern, higher implied volatility for lower strikes, that's the skew.
The market's talking through these volatility patterns. What else from historical data?
Natenberg shows how volatility changes over time. Traders use that past data to understand what might happen, like a weather forecast. Use past patterns to predict, but no forecasts aren't perfect.
Analyze past volatility to try and predict future wildness.
Exactly. He even suggests using weighted averages. More weight to recent data for short-term options. Longer-term averages for long-term options.
Different time frames, like a weather forecast, picnic, or a vacation.
Perfect analogy. Like weather, volatility predictions aren't guaranteed. Analyze the data, understand the market, get insights into risk and reward.
This is great. Natenberg's opened my eyes to volatility, the engine of option pricing. Got to understand it.
Absolutely. Volatility is the lifeblood. Master it to succeed. Before we wrap up, some advanced stuff, delta hedging and synthetic positions.
I'm all ears. Let's dive in.
Okay, so delta hedging. Managing risk, remember delta, how much an option's price changes when the underlying asset moves.
Yeah, call option delta's 0.6 means the option price moves 60 cents for every dollar the stock moves.
Right. Delta hedging tries to neutralize that by taking the opposite position in the asset. So long a call, delta 0.6, you'd also sell short 60 shares of that stock.
Like a counterweight. Stock up, option gains, the short stock offsets. Stock down, option loses, short stock profits.
Precisely. A seesaw trying to stay level. Delta hedging isn't a one-time thing, though. It's constant adjustment. The price changes, the delta changes.
Staying balanced on a surfboard. Choppy water, got to keep adjusting.
Great analogy. Natenberg goes through an example. Traders buying and selling shares. Different times to keep that delta neutral.
Makes you realize options are more than just picking and hoping.
Active management. Now, synthetic positions, another key idea. Combining options and the asset to create positions that act like other stuff.
Like a recipe, mixing ingredients to get a specific taste.
Exactly. Buy a call, sell short the stock, you've made a synthetic put option, same payoff as a put without actually buying one.
We can mimic things. Why not just trade the actual thing?
Sometimes synthetics are cheaper, more efficient, maybe an option's illiquid, or the bid-ask spread's too wide, so you create it using a better option or the stock itself.
Taking a detour when the road's called?
Right. Natenberg gives examples. Traders using synthetics. Create strategies, hedge, or find arbitrage.
This is incredible. Options are like a giant puzzle. So many pieces, so many ways to put them together.
They are. Natenberg explains how to value these synthetics using something called put-call parity.
Put-call parity. Sounds intense. What's that?
It's a fundamental relationship in options pricing. The price of a call and a put, same strike, same expiration, they should be linked to the asset price and the risk-free rate.
An equation connecting calls, puts, the asset, and interest rates.
You got it. Natenberg gives examples of using it. Find mispriced options, arbitrage opportunities, and create good synthetic positions.
This has been amazing. Options trading. Natenberg's book is packed, and this deep dive is just a taste. Any final thoughts from our expert?
Remember, successful trading takes learning, practice, managing risk. Natenberg gives you the tools, but you got to sharpen them. Use them wisely.
Couldn't agree more. Time to put this knowledge to work. Explore the options market. So, to our listener, keep learning, keep experimenting, and never stop exploring.